Hi, welcome to Sphere Day, which is all about simple Forex trading strategy, which is based around trading market reversals. It uses a Bollinger Band and uses the outer bands to spot, high odds turning points. It's a simple strategy. The logic is very easy to understand and it's very easy to apply. And it's really, really effective. You need quite a few pairs to follow to do this, I think, to get the best setups. But you'll probably get a few a month, and they are fantastic opportunities to trade with low risk and high reward. Now, before we look at the strategy, why don't we just review what Bollinger Bands are for those of you who don't know. The Bollinger Band itself is a 20-day moving average at the center. Okay, it's a simple moving average, and then you have two outer bands set at two standard deviations from the midband, and in pure simple terms they will show you the volatility of the market. So the wider the bands are apart, the more volatile the market is. The narrower the bands are together, the market is not volatile. And what you want to do is, if you put up a Bollinger Band, you'll see this. You'll very often see prices go outside of the outer bands. But prices do not stay there for long. They come back within the outer band and then they normally go back to the mid band. Why is this occurring? Just simply that greed spikes prices too far on the upside, fear on the downside, and that subsides, and then prices return to an average price. The average price obviously filtering out those price spikes that are caused by human emotion. So how do you trade the outer bands? Well, I'm just going to give you a couple of techniques I like. There are many more, but I'll just give you two of my favourites. Now, if the price comes up to the outer Bollinger Band and just hugs it or just nudges outside it, I'm not really too interested in that. What I want to see is a big range day. So you've got a wide range and prices spike significantly outside of the band. Now, once that has occurred, what I like to do is look at how overbought the market is. Let's say it's a spike to the upside, put up some momentum indicators and see if the market is at a bullish extreme. Plenty of momentum indicators to use. You should find your favourite, but I like the stochastic, RSI, MACD and ADX. So if you've got momentum overbought, you've spiked outside that band by a significant amount, it's a wide range day, all you do is place an order to take it on a move back within the outer band. Now, the actual best setup of all, like I always think, is that if you have a wide range day, it may not come back within the Bollinger Band on that day. It'll finish near a high. And what you then do is you look at the next day. What you'd very often find is, prices open strongly, make a new high, and then you settle below the previous close. If momentum is an overbought extreme, you can sell that move even though it's outside the Bollinger Band. Sometimes, it depends on the actual way the chart looks, but sometimes it's better to take it on a move back within the band if it's close. But if you're a reasonable way away from the outer band, you get that setup that you have a new high, you settle below the previous close. That normally is a good time to sell. That's just two ways of trading the outer Bollinger Band. Now, I would just, a lot of traders just want to trade without using momentum and price action. It's not a good idea when you're trading the Bollinger Bands. You must have momentum at an extreme when you're outside the band. Some people try and trade them with candle reversals. I really don't think that is so effective. You need to understand historically how overbought, or in a down move, how oversold momentum is. But if you do this, it will filter out the trades for you and give you those ones that are just at real extremes. And it is a very simple strategy, but it is very, very effective in my view. In terms of stock placement, if the market is a bullish extreme, normally you want your stop set back behind the high by a reasonable amount, normally 30 or 50 pips at least, just in case. You see it very often that prices might come up again and try and hit stops. But if you use a reasonable stop away from the high in an up move when you're looking for a reversal, and you trade overbought momentum reversals with the bands, you can actually make a lot of money doing this. My sort of real thing that I'd like to stress on it is when you're doing it, you must have momentum overbought or at a bullish extreme in that market or a bearish extreme in a down market, so that you know that there isn't much more power behind the move, okay, once you've decided to get in. It's a simple strategy. I've been using it now for about 25 years. It's still as effective today as it ever was. It's based on the logic that, you know, traders are always going to spike the market too far in the short term through greed and fear, and that will always subside. So if you try that strategy, I'm sure you'll find it effective. There's many other techniques outside the band, which I haven't got time to discuss here, but those two are two of my favourite ones. So thank you very much for watching me. Take care. Have a good day.